Hello, my name's Steve Griffiths. I'm the Sales and Distribution Director for Kensington. Welcome to the webinar that we're doing with TMA today. Complex doesn't mean complicated. I've spent the last 18 years or so working for Kensington trying to explain that principle to our mortgage intermediaries. So hopefully today I can walk you through some of the areas of our criteria and the marketplace that we're operating in the residential and buy-to-let markets, and hopefully add some real value to some of the criteria points that we can offer your clients, especially when dealing with maybe less straightforward cases, but how we can take a less complicated approach to that. So you can see from our strapline, our tagline is lending for real life, and some of the issues that we come across really aren't that different to what many of us may sort of deal with within our lives of employment or when we're looking to fund a mortgage. So just to kind of run through a few of the more common ones, life events that maybe lead to some issues with customers' credit profiles, so maybe job losses, divorce, relationship breakdowns, etc. The self-employed market for people who own their own business, and contractors or other customers that may have more complex incomes. We do a lot more new build properties with the onset of Help to Buy, and Premier Lending large loan maybe just gives you a bit more of a flavour around the type of cases that we get aren't necessarily all about the credit profile or the income. Sometimes it's about the loan size or maybe the repayment strategy that the customer wants to take that is a little off-piste in terms of high street lenders, or actually just that the choice of lenders that you may have for those type of customers may be a bit more limited. And really for me, specialist lending isn't maybe just about having one or even two of these issues. Quite often we'll see cases where they're a combination of of all of them really, in terms of maybe having somebody who has a less than perfect credit profile, who's perhaps recently started their own business, a second party that maybe has more than one stream of income. And I think that's real specialist lending for me, is where you actually get a lender that is comfortable taking a holistic approach to the whole of the customer's circumstances, maybe rather than just one or two of these areas that may cause you a problem placing with a high street lender. So we're going to talk through how that our approach to those. So typically when you start your research, it would be with a high street lender, and when you get to that point that either it's declined because you put a case in and you've got a declined decision at underwriting or a decision in principle, or actually more commonly we see where perhaps just from an affordability perspective the high street lender may be willing to lend but not actually to the lending objective that the customer wants. And particularly with a purchase, it can be just that larger loan size that gets them into the property that they need, that maybe suits their family better in terms of location or size, and maybe it's not that you're just getting a no, we won't lend from a high street lender, it's actually we won't lend at that amount. And that's where some of our perhaps criteria for income and an affordability can come into play. But typically when you've got to that point, you're really looking outside the high street at that raft of lenders that perhaps you don't deal with on a more regular basis. And they've all got their pros and cons. So it could be some regional building societies have some great sort of niche criteria points, but maybe not so due to sort of capacity, maybe not have the scale for doing lots of that type of business, can be maybe complex around getting decisions. I think the specialist lender and challenger bank market sometimes can be a bit of a grey area if you're not dealing with those lenders all the time, and can be seen as quite expensive in terms of the initial alternative. And maybe on some of those larger loans in the realms of a private bank for high net worth individuals, again some good niche criteria points, but it may have situations where they want to have a banking relationship with the client and perhaps assets under management, etc. So you tend to be sometimes in the realm of actually having some complicated relationships even before you've actually got to the start of actually placing the case. So what we try and do is bring a more straightforward retail approach where it is very black and white, and we can take some of those complex situations and make them less complicated when you're looking to actually place and process the case through to offer and completion. And really we have four pillars of that. When customers' requirements aren't met by the high street, we're going to be looking at the whole circumstances of the case, understanding what is it around their affordability, around their income, as I say, whether it may be a slightly different repayment strategy and they want a higher LTV in terms of interest only maybe, and it's all underpinned by underwriting. And underwriting in the true sense of the word is in that we don't use the credit score or automated decisioning to influence our lending decision. It's actually a manual underwriter that is able to assess the circumstances of the case, and really that's about time. It's about having an underwriting process that gives your underwriters more time to actually look at the case and understand that, to actually look at more supporting documentation to establish that we are reaching a responsible lending decision for your client based on your advice that maybe the high street just doesn't have the time to do because of the volume or the system or their risk appetite that is involved. So they're kind of our four pillars of what we look to take into account. So first of all, in terms of credit history, what we'd be looking at in the main is where somebody's failed a credit score. Now sometimes that can actually mean that it's a very limited amount of information you have. So I think the main thing you have to just take away from ourselves is that we don't credit score. So how much history the customer has in terms of their credit, whether they've got too much credit, not enough credit, doesn't really come into our factor. We're quite happy we can understand the customer's circumstances without an automated score giving us that knowledge. And quite often we do, it's important to realise that we do see credit declines that aren't necessarily due to problems. It could just be the actual profile of the customer that you're looking at in relation to what the high street lender's risk card says that they can or can't do. There are some more straightforward things that you'll come across that are maybe some issues on a credit report or something that the customer's highlighted to you prior to the submission of the case. So communications are pretty regular. People necessarily aren't under financial hardship where they get a default from their mobile phone company. It tends to be a result of an issue they've had in terms of their service provider rather than being under any sort of financial distress. However, when we do see people that have maybe got some more complex issues and they have had some previous issues meeting their payments before, quite often debt management plans maybe come into account. We're quite happy to look at those kind of cases as long as the customer has kept their last 12 months payments and they've demonstrated their ability to support that. And in terms of the more historic issues like county court judgments, default, secured loan arrears, then as long as they're historic, then we're happy to take a view on that. And really what they have and when they have it is really done on a case-by-case basis, because we will have products that will be, for instance, maybe a higher loan to value and a cheaper rate for customers who have more historic issues, maybe say 3 years or so previously. It may be that we can do a slightly lower loan to value but at a slightly higher price for customers that have more recent issues, i.e. 2 years ago or even within the last 2 years. So it's really important, if you get any of those details, just find out what it is and when it happened, and we'd be quite happy. Certainly the decision in principle will work automatically, but if you just want to get some additional comfort for your research, then by all means just give one of our BDM team or our BDU team a call and we'll talk you through that, what that customer's circumstances mean in terms of what products they have accessibility to. So moving on to the self-employed. So just before we go through the KSPs, it's worth just taking a step back and having a look at what mortgage lending relationship has with the self-employed. So in general, depending on which website you look at, but ONS figures generally give a figure of around about 15% of the labour market is self-employed. So in general, that can change in different areas, but as an average about 15%. So it kind of follows that most mortgage lenders should have around a 15% percentage of their customers that are on a self-employed basis. I can tell you that consistently our level of self-employed customers is well over 40%. So it just goes to demonstrate the difference between customers accessing standard funds through the high street or actually needing to go to a specialist lender like Kensington. Why do they need to go? More of those customers need to go to a specialist lender. Again, it's just that underwriting approach to actually being able to understand that their income is sustainable. The main reason that probably a case would fall out on affordability is perhaps because of the track record of that customer's earnings. So typically where a high street lender may need an average of 2 or 3 figures, we're quite happy to look at the most recent year of their self-employment. Again, quite easy to underwrite. You can see, you know, recent transactions, etc., on bank statements will really give you comfort that, you know, their most recent year is very much in line with what their current year and hopefully their ongoing earnings are going to be. Also, as well, an area where sometimes the customer success goes against them is where somebody's been running for a business for a while and actually they've got to the point where they don't need to withdraw all of their income within salary and dividends. So if you have a limited company director, we say this is available for anybody who has more than a 50% shareholding in a business, and actually the profit is actually exceeding their salary and dividends, then we're quite happy to use net profit and salary rather than just salary and dividends, because we take the view that actually if they needed to withdraw that income to support the mortgage, then they can do that. We've always been really strong in the newly self-employed, so minimum of 1 year trading, so we're quite happy once they've got their first year's books to use those figures towards income going forward. And a bigger section of the market that we see at the moment is that contractors, where you have that kind of hybrid role between self-employed and employed. We're quite happy to look at the income based on a 46-week contract rate, as long as they've got a day rate, weekly rate on their contract, and there's some consistency of that you know, they have a couple of months left on that type of schedule. And we can also look at some new contractors. Again, if somebody's maybe, you know, been quite successful in their PAYE position and has moved into typically a self-employed or maybe umbrella company position at a higher income on a day rate, then, you know, as long as we've got that good track record, the same if somebody's taken a gap and maybe taken an extended holiday or actually taken a gap to do some further training, which is quite common in the contractor market, then we're quite happy to look at those. So whilst we're not saying that is exclusively a specialist lend, there probably is a smaller pool of lenders that are willing to lend to contractors on their day rate, and actually they may have some restrictions around some of the things that we can consider, whether that's new gaps or maybe profession type or the minimum income requirement to be considered a contractor. So really big part of our business. We've always been strong in it, and we continue to look to find new ways to assess self-employed customers' income, so we can put them on a similar standing to our employed customers. So moving on to employed customers, in terms of complex income, what's complex income? I suppose this really comes down to if you have customers where they don't just have a nice equal earning on their pay slip every month and a P60 that looks the same pretty much every year. And quite often this comes down to where there's an element of variable income. So typically within the sales industries where you have a high degree of bonus commission, or it could be overtime, you know, in different types of industries. Any of those variable incomes, what we're looking for is if somebody's got a track record, then we're quite happy to take that track record over a couple of years. We don't need to limit that on having capping that out on their basics. So particularly, you know, your likes of maybe somebody who works within the maybe a state agency, car sales, etc., where their actual gross earnings would be a very different split between their basic and their variable. We're quite happy to take all of that into account. And complex sometimes just means that they have different income streams. So where many lenders may only take a certain percentage of second income, as long as we can underwrite that that's consistent. So if they have a second job, maybe if they have some investment income or buy-to-let income, as long as they're paying UK tax on it, and again that track record is demonstrated over a couple of years, then we're quite happy to take that income going forward. And it can be the difference, you know, affordability calculations aren't necessarily just what comes out of the calculator in terms of the multiple. Although we are pretty strong in that, you know, and we're quite happy to lend up to the higher income multiples for certain customers, up to 6 times income. But it's also about what goes into the calculator. It's about, you know, what income we're actually going to take for your customer. We could look at a customer and say actually their income's 80,000 versus a high street lender looking, because they may be only taking half their income or an average of their self-employed, and they could be looking and saying, well, okay, that customer's income 60,000. So it's really important to understand from a specialist lending perspective what the income is that actually can be taken, because that can really make a big difference to somebody whose position is slightly outside the norm. Just finally on that slide, agency workers and 0 hours, again, as long as they've got that track record, then we see that as being, you know, able to demonstrate that over a couple of years. Most of those agency workers do have the same rights as employed workers, and quite often they can be working in the same end client, you know, big distribution centres these days, supermarkets even, you know, car factories, and they're not actually working for the end producer, they're actually working for an agency that has a relationship for flexible working within that business. But some of these customers we see have been working there for years. So you know, that type of customer, absolutely, you know, we should look at those as somebody that has a sustainable income going forward. We talked about interest only, and it's worth just sort of really focusing on actually how much of the market is out there. Certainly we're coming to that period when interest only was a huge part of the market 10 or 11 years ago, as you can see, sort of you know, 30% of mortgages back in 2007, much lower now. But actually what we're seeing is there's some maturing customers that are coming off the end of those periods, and some, you know, worth bearing in mind, maybe a lot of the lenders that were in 2007 that were very active in that type of market may not be even here. So the customer might have been ticking over quite nicely on a, you know, a Bank of England tracker that's kept quite low over the last few years or so. You know, wouldn't have the opportunity maybe of a product transfer. So you know, it's another area that where we're quite happy to look at those kind of situations. And whilst we've looked into later life lending, there are some industry launches out there in terms of retirement interest onlys. We don't have one of those products at the moment, but what we are able to look at is where customers need to take a bit more of a flexible approach of that, where we can look up to a higher LTV of interest only of 75%. Combining that and maybe part and part up to 90% LTV, should the customers need to structure that repayment strategy slightly differently. And probably the main thing is that, you know, we don't insist on a piece of paper to support that strategy. You know, what we're looking at is that really much more of an explanation of that strategy, and we're quite happy that that means that it can be different routes in terms of what income is allowed. So it could be their buy-to-let equity, it could be investments, it could be a combination of all two or three, or it could just be a straightforward downsize in that they won't need the size of house that they've got in another 10-15 years time, and they'd be looking for a downsize with that equity. So just moving on into buy-to-let, covering most of the main residential issues there. But in terms of buy-to-let, we've made a lot of changes this year. So mainly where we're looking at the more complex side of the specialist market that perhaps traditionally isn't catered for by the high street. So higher LTVs, we've moved our maximum LTVs up to 85% on our standard products, and 80% for our HMO and multi-unit products. And probably the biggest success, I would say, and the biggest increase in business this year has been our limited company product that we launched in June of this year. The big difference this, and probably if there's one element of making something that is perceived as being complicated less complicated, it's our approach to limited company. So traditionally, probably in most cases, you'll see a limited company probably goes hand in hand with a portfolio landlord. And as we all know, there's been a lot of changes to how you actually assess portfolio landlords in terms of the underwriting. So where we're slightly different is we treat the limited company as the landlord in that situation. So typically, if you have a situation where maybe I have 10 properties in my own individual name and I'm purchasing my next property on the advice from my accountant as a limited company, we don't need to actually underwrite the affordability on all of that portfolio. It's just a straightforward standalone limited company without any portfolio rules, and that also takes into account obviously sort of in terms of our bespoke affordability calculator, the benefits of the lower tax bracket of that limited company as well, rather than maybe some of the higher tax bracket that we need to apply for somebody who has a lot of rental income into the background. So it's really important to understand that not all of those limited company transactions are very complicated. It's a nice, easy, straightforward way to do that. We've mentioned the portfolio top slicing. Really what we look to do is, rather than just give a straight interest rate calculation of saying it's 125 or 145, we've got a bespoke calculator. You can very quickly just put your details in there of your client, and it will give you a maximum loan amount. In terms of pricing, with all of our pricing, we don't have any application fees up front, and there's a free valuation on pretty much all of our product ranges. And in terms of our portfolio landlords process as well, if we are assessing it, we don't ask for lots of business plans or asset and liability statements. We just ask for your portfolio spreadsheet. You can provide your own one or the customer's one with our application. And then in terms of the other details that you get with it, we just ask for 3 largest ASTs. So again, hopefully a nice easy way to underwrite those type of cases of something that can be seen as pretty complex in the market. In terms of our other changes that we've made recently, we're now in the 95% market. We go up to 500k on our 95% products, very popular for our first-time buyers. We've increased our larger loans and our new build, so new build properties we now go up to 90% for houses or flats. We obviously have our standard Help to Buy products for customers buying through the Help to Buy equity loan, and recently launched in the Right to Buy market as well for both houses and flats, subject to value. So hopefully trying to give you a really broad range rather than just seeing as a lender like Kensington as a straightforward credit decline. It is not necessarily just about that. It's about all those other affordability plays that may be really important in getting customer to the actual loan amount that they need for probably a fairly short period of time. Typically, you know, most of our customers would leave at the end of their early repayment period, and just giving you a really broad range of products to offer customers that maybe you've run into trouble with at the high street stage of the process. Thanks very much for your time. Be happy to take any questions over the presentation for this or for any other aspects of Kensington. If I can answer them now, then we can. If not, we can take them offline and get back to you after the presentation. Thank you.